Okay, hello everybody. I'll start the webinar now. I'm sure there'll be more people join us as we go through, but they can catch up to see where we are now. So, hello everybody, and welcome to today's webinar, which is about a QNUPS, a qualifying non-UK pension scheme, and how British expats can take advantage of this to potentially reduce their tax burden. So going to cover the webinar today. Hopefully cover as much as we can on the QNUPS. For these sort of webinars, I always say exactly the same, that we're not providing advice today. We are giving information on this product. It may suit some people, it may not suit others. There may be other options available. We're not tied to the QNUPS. There are a lot of tax planning opportunities available for all. But if something that is discussed today resonates with you and you're interested in chatting about this a little bit more, then reach out to us. So a quick introduction. My name is Matt Penfold from Fiduciary Wealth Management. We're based in Gibraltar. We are here serving the expat community, generally British expats in Spain, Portugal, UK, and Gibraltar. We do have clients who come from other countries who are living outside of those areas, but that is really our kind of core clients. Today's webinar is about the QNUPS, and we'll get through the agenda. What I would say, if you're watching this live or a recording via our YouTube channel, there's a lot more content on our YouTube channel. We've got our podcast, which we temporarily stopped. We'll be starting that soon. A lot of other webinars, a lot of free content on there. So if you can subscribe, like, share with anyone who may be interested in that content, we'd really appreciate that. So today's webinar is about the qualifying non-UK pension scheme. So at the start, we'll cover what is a QNUPS, what are the rules surrounding it, how much can you contribute, and what sort of assets can you hold, and why would somebody use a QNUPS? Then we'll talk about UK domicile and UK inheritance tax, which ties into a QNUPS. That will become clear as we get to that area. We understand the tax and succession planning opportunities of using a QNUPS. So how does it work from a taxation point of view? And that will include the taxation of the income that derives from that, which is classed as pension income, and how somebody can use a short-term annuity to lower your tax burden. At the end, we'll cover a few common pitfalls that we see with a QNUPS, and then a little bit of advice at the end. And finally, I will open it up to any questions that anyone joining this live webinar may have. So on the Zoom webinar we're doing now, there's a question and answer function at the bottom. You have any questions, please submit those questions throughout the webinar. The earlier, the better. And then I will pick those up at the end. Okay, so let's get started. So first question, what is a QNUPS? Some of you may never have heard of this. Some of you may be familiar, but those who haven't, it's a qualifying non-UK pension scheme. Okay, so that's what it stands for. We'll refer to it as a QNUPS for the rest of the webinar. And in truth, a lot of what is a QNUPS is explained by its name. So it's a non-UK pension scheme. So there's a lot of information out there that says a QNUPS available for people who are tax resident in the UK. That's not true. It's for Brits who are now living overseas. And it is a pension scheme. Okay, but it's not a pension scheme as we are used to. So we're generally used to a pension where you contribute throughout your life, you have tax relief on those contributions, you build up your pension throughout your working life, and then you use it to fund your retirement. A QNUPS is funded via a lump sum, and as you are a non-UK tax resident, there's no tax relief on that investment. So you have a lump sum, maybe you've sold UK properties, maybe you've had UK investments like ISAs, similar, that are no longer tax efficient now that you're not living in the UK. Maybe you have a lump sum that you've taken out of the sale of your business. So it's a lump sum investment that will be placed within this pension structure. Okay, so what are the key features? Why would you use a QNUP? So as I said, it's funded for a lump sum investment, and once it's in that pension structure, the money, there's no capital gains tax on the growth. So capital gains tax in European countries can be relatively high, 28% in Portugal, even if you're within the NHR, up to 26% in Spain. And as I said before, if you had ISAs or UK investment structures, they no longer, Spain and Portugal and other countries don't recognize that ISA. So you need to protect those monies or those assets from capital gains. Now, the income withdrawals that you pay for QNUPS, they can be paid at a very efficient tax rate. We'll cover that a little bit later. And now another key part of the QNUPS is that because it's a pension, once you invest that money in lump sum into your pension, that amount is immediately outside of your estate for UK inheritance tax purposes. So you've relocated out of the UK, you think, I'm not worried about UK inheritance tax. That's incorrect. You are likely still liable for UK inheritance tax. And again, I'll cover that later. But if you invest in the QNUPS, that part or that amount is outside of your estate for UK inheritance tax, even if you return to the UK at a later date. So that sounds great. You may be thinking, I want to use a QNUP. What are the qualifying rules? So it's very important that a QNUPS is set up as a genuine retirement vehicle, and funding has to be in line with your circumstances. So what they mean by that is the amount that you invest has to be reasonable and in line with your overall wealth, your age, and your future income requirements. So what we mean by that, and to use a practical example, you have a net wealth of say £4 million or euros. You're now age 75, you're concerned about inheritance tax. You think, okay, I'm going to put 3.5 million into the QNUPS. That's outside of my estate. Great job. That won't work. That's clearly a inheritance tax fudge. HMRC will see straight through that, challenge it successfully, and that amount will still be liable for UK inheritance tax. So it has to be set up as a genuine pension requirement. So you invest a lump sum, the earlier the better, and that can provide you with an income in your retirement as and when you wish to take it. The main caveat is that the income you need to start, or most pension schemes say you need to start taking the income at least by the time you reach 75. And again, that's to demonstrate that it's a genuine retirement scheme. So how much are you able to contribute? I think I've covered that then. It depends on your individual circumstances. So yeah, again, your overall wealth, what pension requirements you have, and what pensions you have already. So some people might have huge amount of pension, and therefore, do they need this additional pension? Maybe HMRC will challenge that. Some of you may have been self-employed, maybe haven't built up as much pensions, have a small amount. Maybe you have pensions, but your spouse doesn't, or vice versa. And that's where a QNUPS could be a useful tool in your investment strategy. So what assets can be held? Well, it's generally is a little bit more open than other offshore products like an offshore bond, which are restricted to UCITS funds. So you can invest in collective funds, ETF, model portfolios, or a kind of similar structure. The key is to work with someone who can provide that investment advice, and that this matches your risk appetite, your aims, what you're looking to achieve. Typically, you can't invest in things like UK commercial property that you can in some UK pension schemes, and generally a QNUPS is only available via an advisor. So you need to work with an advisor that you trust, understands how a QNUPS works, understands what investments can be held with that, can manage that on your behalf, working alongside of you, and make the most of that. Because of course, part of the purpose of this is not that you're just investing this money in this shield away from tax. You want that to grow in value. That grows in value until you're taking income. There's no taxation on that. So you want a good, solid investment strategy. So I go back to one of the major points of using a QNUPS, which is the inheritance tax. And so this is where we talk about something called your domicile in the UK. So generally we have our tax residency that's dictated by where we're living. So you live in the UK, you're a UK tax resident, you then sell your UK home, retire, move to Portugal, Spain, Gibraltar, you are a tax resident there, and you pay tax on your income, capital gains, that sort of thing in your tax residency. But for the purpose of inheritance tax, the UK is rather unique. Countries like Spain and Portugal, inheritance tax or succession tax in those countries is based on your tax residency, where you live. In the UK, it's based on your domicile. So we tend to acquire our domicile at birth. So where were we born? Where are our parents born? So you're born in the UK, your parents are from the UK, you're a UK domicile. We can acquire a UK domicile over the years. So if you move to the UK, you're there for 10, 20 years, the chances are you will acquire your UK domicile, and therefore that means you're liable for UK inheritance tax. So people often think, right, I leave the UK, I'm no longer UK domicile, and it's not as simple as that. So the rule is that you need to be outside of the UK for at least 5 tax years, but you also have to have cut all ties with the UK. And bear in mind that HMRC in the UK, they rely on inheritance tax a lot. There's a lot of money that they take in taxation from inheritance tax. That is growing each year. I think the average is around 260k now, which has gone up from 220k before. So they're very keen on inheritance tax, and HMRC will of course challenge people who they believe to be UK domiciled. So what they will look at, yes, where you've been living, how long you've been living there, but do have ties to the UK. So if you have property, family, work interest, you're still spending a lot of time in the UK, you have things like bank accounts, subscriptions, or other matters, HMRC may challenge you. And the issue with that is, say if they do challenge you on your death, you're not there to defend your position. So we always say with UK inheritance tax, it's better to plan for the worst and have that peace of mind, rather than fingers crossed, hope HMRC don't challenge you and put the strain on your estate and your beneficiaries when you're no longer there. So UK inheritance tax, plan for the fact that you're likely still UK domicile. There were famous cases where HMRC has successfully challenged it. The one that is probably the most high profile is the late Welsh actor Richard Burton. He left the UK 20 years before he died, sold everything, exited completely, had it checked by professionals. They thought he was covered, had a wealth of around 5 million when he died, which was a large amount. Well, it's a large amount now, a really large amount back in those days. And they made one mistake, and when he died, he had already bought a burial plot in his home country in Wales, and that's where he was buried. And HMRC challenged his estate on his death, and they were successful. And their argument was, you had this burial plot, you always had a connection with the UK, you always planned to return to the UK. That's where your home is, therefore your domicile and UK inheritance. So they were successful, and he paid, I think, over 2 million in inheritance tax. Huge amount when we consider inheritance tax is 40%. 40% on assets that you built up for your life that you've likely already paid tax on once. So if you want to plan seriously about passing on your hard-earned wealth to your beneficiaries, then a QNUPS is a really good tool to do that. So, okay, let's understand the tax and succession planning. So we're going to cover the succession planning. So again, if the QNUPS is set up as a legitimate scheme, set up with the right funding in the right way, then that's outside of your estate for UK inheritance tax. For the succession tax or inheritance tax of your country of residence, you need to check the kind of rules regarding that. In Portugal, there's no succession tax as long as you pass that on to direct descendants. Here in Spain, in Andalusia, there's no inheritance tax on the first 1 million and only 1% on the amounts above that. So really, I mean, this can vary in different regions of Spain, so please check the kind of local rules. But really, when we're talking about these areas, again, Gibraltar, no succession tax, it's the UK that we need to be concerned about. And the QNUPS is one of a few tax planning opportunities that you can take advantage of. So how is the QNUPS treated? We've talked about the inheritance tax benefits. What about when you're still here and you're using the QNUPS? So firstly, I've covered it before, I'll reiterate, no capital gains on the growth of that. So there's no tax or reporting required on that QNUPS on any gains until you take the withdrawals on that. Now the withdrawals, again, that depends on your country of residence. Gibraltar, very simple. Gibraltar QNUPS, like a QUPS, and for those who've heard of a QUPS before, a QUPS is a similar product, but it's funded from a transfer of your UK pensions. So if you already have UK pensions, reach out to us. We can talk about those options as well, but today is just about the QNUPS. So for Gibraltar pensions, QUPS or QNUPS, it's 2.5% income tax on the income. So only 2.5% on that. In Spain and Portugal, the income you take is added to your taxation, so your income tax. But there is a way that you can take the income at a lower tax rate, and that's via the use of what they call short-term annuities. So this is an annuity that you may be familiar from the UK. In the UK, we have annuity where you have a pension pot, you use that whole amount, you buy an annuity from an insurance company, and they say, okay, thanks for the money, we will give you X amount per month for the rest of your life, and then that tends to end when you pass away. This is a short-term annuity that's used just how to pay the income. And the rules are ever changing in countries like Spain and Portugal, so it's important to kind of keep up with these. But effectively, what you do is you can designate how much income you're going to take from the QNUPS on a short term. Now, in Spain, you previously were allowed to do that for 3, 5 years and then renew this. They no longer now allow a renewal, so you can only use the short term annuity once. So the most sensible way to do this is to fix it for a long period of time. So say 25 years. So you need to be comfortable with how much income you're going to take in that period. You say, okay, I'm going to take this amount for 25 years. Because of the way the income is assessed when it's paid via a temporary annuity, in Spain, if it's taken over 25 years, they only view 25% of the income is taxed. So effectively what they're assessing is, we only want to tax the gain element of the QNUPS. We don't really have the sophistication to measure which is gain, which is return of capital. So we'll just tax 25%. In Portugal, you can still potentially use the short-term annuity over shorter terms, so 3 or 5 years, and then renew it. And Portugal, they only tax 15% of it. Okay, so the way it works is you would take that amount, the 15 or 25%, and then apply that to the tax rate. So Portugal, as an example, under NHR, you pay 10% on income for pensions. Only 15% of the income is taxed using a short-term annuity. So effectively, you've got a tax rate of 1.5%. For Spain, it's 25% of the amount is taxed, and it varies depending on the tax rate. They have progressive tax rates like we do in the UK. So the income that you're paying, so the tax you're paying on the income varies from around 2.2 to a high of 7.2. It depends how much your income you're taking overall during that year. But what we can say for certain is using this method, you can vastly reduce the income tax rate you are paying on that. 2.5 in Gibraltar, 1.5 in Portugal under NHR. In Spain, between about 2.2, 7.2. In Portugal, post NHR, so post that 10-year period, it'll be similar to between about 2%, 5%. It works out. So again, it needs to be structured correctly. You need to ensure the people managing that for you and advising on it know what they're doing. But there's a very generous tax rate you can pay on the pension income. If you return to the UK, then a QNUPS income is treated just like any ordinary pension in the UK. So it depends on your income tax levels during that year. So what are the common pitfalls of using a QNUPS? So firstly, it needs to be a registered scheme. It's a non-UK scheme, but it needs to be a qualified scheme. Some pitfalls we've seen recently, for individuals living in Portugal, I've seen people advised to use a Guernsey scheme. Now, Guernsey is blacklisted in Portugal. So there could be tax consequences of using a Guernsey scheme. So if you live in Portugal, you should not use a Guernsey scheme. Our advice is, if you're in Gibraltar, use a Gibraltar scheme. If you're in Spain or Portugal, use a Maltese, a scheme that's set up in Malta. The reason for that is Malta and Spain and Malta and Portugal have a double taxation agreement. That double taxation agreement states that there's no withholding tax in Malta, so it's all paid gross. You only pay the tax in Portugal and Spain at the rates we discussed earlier. Also, Malta is not blacklisted by Portugal, so there are no problems there. So that's one pitfall that we come across. Another is, and again, I've covered it previously, but ensuring the funding is correctly. Another one is okay. It's great setting up this tax structure, but you've got to ensure the assets within that are managed professionally, and that there is growth to take advantage of these tax benefits. And lastly, you just need to be aware of the fees when setting up a QNUPS. Historically, in countries like Spain or Portugal, there's been advisors who take large commission payments from your investment. You need to avoid that. You should be paying on a fee structure only, nice and transparent. Here in Gibraltar, our advisors here are regulated to give advice in Spain and Portugal, I will say that, but here in Gibraltar, the financial services mirrors the UK. So it's a little bit more robust than maybe some advisors in Spain and Portugal. And we work on a fee-based system, just like introduced in the UK. So you need to avoid that commission structure. So it's important to understand, the nuances of what you're doing. And I guess the last thing is that when we talk about common pitfalls, QNUPS isn't for everyone. It depends on your individual circumstances, and there may be other options for you. Other products might be better for you. You may want to use a combination of a QNUPS and something else. Again, that needs to be individually assessed. So we're not going to tell anyone today that the QNUPS is perfect for you, but if you feel that it may be suitable for you, feel free to reach out to us. It's Fiduciary Wealth. You can visit our website, fiduciarywealth.gi. Or you can contact us directly. Inquiries with an E at fwm.gi, or my email address is there on the Zoom. If you want to reach out to me directly, I'll be more than happy to talk to you. So finally, and we're asked this quite often, what is one piece of advice we would give to anyone concerned about succession tax in their country of residence and potential UK inheritance tax liability? So our answer always with that is a QNUPS may be an option and may not, but key is the earlier you plan, the better. Okay, we talk about the funding requirement, and that's applicable for QNUPS or other products. The earlier that you can fund that, the better, because you're a younger age. There's more room for growth, and therefore the amount that you can use in a QNUPS would be higher. The also thing is, we said before, don't, plan for the worst with UK inheritance tax. We all have a tendency, some more than most, to think, okay, I'll do this next week, I'll do that next month, I'll do that next year, and just try and hide and forget this as a possibility. If you want to leave the majority of your assets to your beneficiaries, you want a stress-free way of them dealing with it for them and making that easy for you, then you need to plan and do that with professionals who can help you with that. Bear in mind again that a QNUPS is a pension arrangement. So in the unlikely event that you go into bankruptcy, the amount in the QNUPS is segregated. When it comes to your passing, you don't need to go for a lengthy probate period, because you can submit a letter of wishes. You can designate your beneficiaries as part of the pension structure, because a pension is effectively a trust structure. So from that point of view, it is helpful as well. So yeah, we say to everyone, come on, you should, the earlier you can plan, the better. And for those who are watching this who've left the UK, you're planning to leave the UK, and we would say, speak to us before you leave. The earlier the better. You know, you want to move to Gibraltar, Spain, or Portugal to enjoy your life in retirement, stress-free, enjoy the beautiful climate, the beautiful food, activities, then you put this in place, and it's something that's done, and you have that peace of mind as well. So I think the earlier the better would be the advice we give on that one. Okay, so that's the end of this webinar by myself today. As with every webinar, we can't cover every detail in minutia. Otherwise, A, would be here all day, and B, we need to cover different things that aren't applicable to everyone. So if you are interested in a QNUPS and you think it may work for you, feel free to reach out. Before we close, we do have a couple of questions. So we've got a question from Paul. What sort of fees are charged for setting up a QNUPS? Paul, it depends on different circumstances, the amount of the QNUPS, the provider being used, where you want your investment structured as well. So again, happy to have a conversation with that on an individual basis if you want to reach out. Anonymous has asked, do we do with UK SIP funds? I'm not sure what that means. Anonymous, if you want to kind of reword that for me. If I understand correctly, you're talking about a UK SIP and what do you do with what do we do with UK SIP funds? Okay, thank you. So a QNUPS is funded for a lump sum investment. A UK SIP, you have a few different options. Now, the alternative to a QNUPS is a QUPS. And if you're in Spain or Portugal or Gibraltar, we've run some webinars on those areas and financial taxation in particular. So if you want to check on our website, so our YouTube channel or on our website, you can find those videos. They will talk about the QUPS. I'm not going to bore everybody about the QUPS today, but you can use a QUPS to transfer your UK SIPs. Or you can move your UK SIP to an international SIP as well. There are a few different options. So you don't use a QNUPS, but there are options. So again, if you want to have a conversation with us about the options that you have, feel free to reach out to me, Matt Penfold at Fiduciary Wealth Management. So a question from Mark. So after 10-year NHR, marginal rate of income tax is approximately 48%. So 15% of 48 is 7.2. Is this correct? Yep, I'm not going to check your maths on that one, Mark, but you've understood it correctly. I mean, 48% is a high rate. Portugal, like Spain, like the UK, the rate of tax increases. I think it starts around kind of 18-20% and goes up in kind of smaller increments than the UK. The UK, we have the kind of 3 bands. I think Portugal is around 5. But if your marginal rate of tax is 48%, then you apply 15% to that, and that's the tax rate that you offer. Anonymous attendee, can you set up a QNUPS if you live in the UK and don't want to move abroad? No. Is a non-UK pension scheme. We do read about this online, and there are firms promoting that. we would never do a QNUPS for someone who is remaining in the UK. If you're planning to relocate out of the UK, you can set up the QNUPS in advance, but ourselves, we would want to accept something from you to confirm that you are going to move. It's not a case of you're setting up, I'm going to move and I don't. If you're not planning to exit the UK, then a QNUPS does not work for you. Okay, and there's a final question which is incredibly lengthy there. And it's very complicated on that one. And you're asking about a lot of kind of properties and things like that. I think with a question like that, we don't have the time to cover that. If you want to reach out directly to us to have a conversation, because a little bit of the information you say seems to kind of contradict. You're talking about being in the UK but exiting the UK. If you're remaining in the UK, then we wouldn't look at a QNUPS for you. That's our answer to that one. And more questions coming in. Okay, I mean your question there is another firm would set up a QNUPS for a UK tax resident. That is only a question that they can answer, but I guess I would ask them, why would it be a non-UK pension scheme for an individual who's a UK resident? But that's on them to deal with. But I think if somebody's giving you advice as a UK tax resident to set up set up a QNUPS as a UK tax resident, I would double check that with a UK accountant and see how kind of legit that advice is. And a final question, have you any dealing with offshore curbs? I don't know what you're referring to as offshore curbs. So again, if you want to kind of specify a little bit more what that is, feel free to research. So you've changed that to FERBs. Again, I don't know what that is, Alan. So happy to have a chat if you want, and you can kind of enlighten me on that, and we can look into that for you. Right, great. Well, a lot of good questions there, a lot of involvement. So I appreciate those questions and very grateful for those who have attended today's webinar. Whether you are watching this live or you're watching the recording on QNUPS, we are grateful for that. And once again, I'd ask if you can subscribe to our YouTube channel and then like and share the videos with your friends and people that you may know from the expat community or those who are planning to relocate. Because at the end of the day, that's free information. We're putting that out there for you, and there'll be a lot more content coming. We've got a couple more webinars this week. We'll be relaunching our podcast for expats very shortly. So for now, I will say thank you for joining us. I hope that was helpful. And for those who are interested in a QNUPS or the alternative options, or just discussing their financial planning as an expat, feel free to reach out. We'll be more than happy to have a chat with you. But for everyone, have a lovely day, and hopefully we'll speak to you soon. Thank you. Goodbye.